Let's get a spoken word on the summertime stock market now, shall we, from our chief equity strategist here at Zacks, John Blank, joining me via Skype. John, you're taking a look at this summertime stock market as probably a sideways proposition, huh?
I am, Terry. I was just on a call with the index committee with the Standard & Poor's, and they're telling me that a quarterly number is $27 a share that we're delivering right now with this economy. So if you take a very bearish view, Terry, and take it to $26 for the next year, if you really think there's going to be a decline, you get a $104, base. Put a 15 PE handle on that, Terry. That's $15.75 for the low. And then if you get bullish on next year, you can get up to 110, 115, even up to $120 a share next year, which in a range trading sense is going to be about a 1675 high right now. But that's going to continue to go up and as people get more confident on these underlying earnings numbers.
So we're still looking at an underlying bull market here?
Yes, it is, Terry. It's a bull market, but the range between the earnings lows and the earnings highs has to be hashed out here. And that's going to take some time. And then throw in the taper talk, which is going to carry on all the way through the fall. And until people actually see how that plays out, that's another source of uncertainty, and the market's going to be depressed from that.
So if the stock market is a forward-looking indicator, as we always hear, John, is what we're seeing now in the market's way of looking beyond QE?
I think it is, Terry, because the market's projecting that QE is going to end in December of this year, more or less. Some people think September, some people March, but let's put it December. And a 12-month forward-look market, that means 6 months of this year is before that taper and 6 months is after, and that's being factored in. So it is true that we're already getting some weight of the taper into this story, and that is another part of what's digesting in this market as it sorts out where it wants to be.
All right. Well, it's going to be an up and down proposition, I can imagine, volatility-wise too, right?
Absolutely, Terry. All the way through the fall, we're going to see this go around and around as the market debates whether or not we're going to go higher and see these earnings growth rates go up, or whether we're going to see the taper take the bond rates up and slow the growth such that the Fed can't get down and play the game anymore.
In the meantime, talk to me about some industries you find interesting right now.
Terry, the main industry you got to focus on is the finance industry, and that is a broad number now that includes the insurance companies, the real estate companies, the investment managers, the major banks, and the regional banks. All of these areas of the economy have to go up with the growth of the economy, and they will not be able to have the Fed pull back without seeing that growth rate and that strength, because ultimately that is where the economy is going to go from here, and those they have to benefit. So it's hand in hand here. If you want to buy this market and you want to be a bull, you've got to buy some finance exposure, and I particularly like the insurance companies right now.
Okay, anything else?
Terry, I think, beyond that, you should take a look into the healthcare companies and the IT companies, because what we're going to see here is not just a cyclical bent, because I don't think that's the case. I'm thinking more of a growth at a reasonable price bent to this market, meaning the market's going to take a hard look at valuations and true them up with growth rates. And so if you can find a sector that has valuations and growth, that's where you want to be. And those three sectors are going to be the banks, the IT firms, and the healthcare companies.
All right, it's always interesting when we talk with John Blank, our chief equity strategist here at Zacks, get his spoken word on a variety of things. With John, I'm Terry Ruffalo.